teaching you some useful vocabulary related to the stock market. And we're going to start out with some more basic vocabulary and then move into more difficult words and phrases.
Meet Adriano. He lives in Venice and is obsessed with coffee. Adriano runs his own small coffee house, but he wants his business to grow. Adriano knows he'll need a lot to expand his coffee house: a proper space, furniture, good suppliers, talented baristas, etc. He calculates it'll cost him $200,000. The thing is, Adriano only has $20,000. So he decides to issue stocks. A stock is a part of ownership in a company. Each stock has its value. It depends on the company's worth. Adriano needs $180,000 more to open his coffee house. So he divides his business into 9 even shares and attracts 9 partners. They invest $20,000 each. Now Adriano and his 9 partners each own 10% of the coffee house. 6 years later, the coffee business prospers. Adriano has opened 3 more coffee houses, and the company's value is $2 million now. Adriano got the capital he needed without borrowing money and paying interest. He and his 9 partners increased their initial investments from $20,000 to $200,000. But it could work the other way round for them. Adriano's business may fail to compete with other coffee houses in the neighborhood, or prices for coffee beans may soar and squeeze profits.
A stock market is the place where shares of publicly traded companies are bought and sold. This buying and selling often leads to fluctuation in stock price. Moreover, these companies are registered at a particular place called exchanges, including the National Stock Exchange and Bombay Stock Exchange, for people to buy or sell. The investors purchase those shares, which allows the company to raise money to grow its business. Stock market does come with risks, but with the right investment strategies, it can be done safely with minimal risk of long-term losses.
Broker. A broker is a person or firm that conducts transactions on behalf of a client. Some brokers only conduct transactions, while others also offer different types of investment advisory services. Brokers derive their profit from commissions on orders given. That is, they usually collect a percentage of the value of each transaction, though some charge flat fees. Clients may give orders in a variety of ways. One may meet with a broker, call on the telephone, or give orders over the internet. Brokers handle 2 main types of brokerage accounts: advisory accounts or discretionary accounts. Brokers are only allowed to conduct transactions on advisory accounts on the specific orders of the account holder or under very specific instructions. On the other hand, they have much more leeway over discretionary accounts, conducting transactions not prohibited by the account holder in accordance with the holder's investment goals and the prudent man rule. In practice, most brokerage firms are in fact broker-dealer firms.
What is a share? A share is simply part ownership of a business. Shares are issued by companies to A. raise money for future development, or B. perhaps the existing owner wants to sell off part or all of the company by selling shares in the company to others. How are shares created? There are 2 ways you can buy shares in a company. The first is through a float, which can also be called an initial public offering or IPO. This is where shares in a company are offered to the public for the first time. Buying shares in a float is called buying on the primary market. The company submits details of its business and the share issue to the Australian Securities and Investment Commission, ASIC, in a document usually called a prospectus. Once lodged with ASIC, the offer is then available for potential investors to assess. If you want to buy shares in a float, you must first review the prospectus. The price investors pay for the shares will be determined by the company. The company will either state the price in the prospectus or set out the method for determining the issue price.
A dividend is a payment shareholders receive from a company's earnings. When a company is profitable, management can choose to reinvest profits to help grow the business or distribute those profits to shareholders in the form of dividends. Dividends come in several forms, but the most common is cash, which is deposited into shareholders' investment accounts.
A bull market refers to an economic state in which the price of tradable commodities experiences an upward trend, generally classified as an increase in market price of at least 20%. Most commonly, this is in reference to the stock market. but it can also apply to anything that is traded in a virtual market space, including bonds, real estate, and even currencies.
A bear market is a period of time when the broader stock market declines by a significant amount. And while the name might seem scary, a decline in the broader stock market is a normal part of the investing process. There are generally two types of bear markets: minor corrections and full-fledged bear markets. A correction is when the broader stock market, such as the S&P 500 index, declines 10% from its highs. Corrections are common and are typically seen several times per year. Corrections occur for different reasons, such as a negative economic report or poor earnings guidance issued by a high-profile company. A full-fledged bear market is a more significant decline. This type of bear market occurs when the S&P 500 declines 20% or more from its recent highs. However, bear markets generally occur infrequently. For instance, from 2000 to 2013, the S&P 500 experienced two bear markets.
The difference between a bullish market and bearish market. A bull market is used to describe conditions in which prices are rising, and bear market is one in which prices are heading down. When the bulls reign in the market, people are looking to invest money, confidence is high, and the acceptance of risk generally goes up. In a bull market, traders are looking to enter the market when prices are rising so that they can sell once they believe the market has reached its peak. Bearish markets follow a downward trend as investors sell riskier assets such as stocks and less liquid currencies such as those from emerging markets. In a bear market, traders are looking to enter the market when prices are falling so that they can buy once they believe that market has reached its peak. The terms bear and bull are thought to derive from the way in which each animal attacks its opponents. That is, a bull will thrust its horns up into the air, while a bear will swipe down.
Volatility in simple terms. Volatility is an up and down market movement. Let's assume you expect a stock to be at one price, but over a short period, it drastically goes up or down. Calculated as a standard deviation from the expectation, such movements reflect volatility. If a position goes through remarkable changes in value, we call this position highly volatile. Vice versa, low volatility means the position is stable. High volatility brings uncertainty and scares people. At the same time, highly volatile positions can generate much profit if you're willing to take the risk.
Market orders. A market order basically says buy this stock as soon as possible or sell this stock as soon as possible. Limit orders, which give you more control over your trades. A limit order is what you use when you want to buy or sell a stock, but you don't want to pay more than a specified amount for it. The same concept applies when selling a stock using a limit order. You won't give it up for less than the amount you specified.
What is bid? What is ask? What is bid and ask spread? Individually, bid price means the maximum price that a buyer is willing to pay for the security or a share of stock at that particular point of time, and the ask refers to the maximum price at which the seller is willing to sell the same security or the share of the stock at. A transaction or a trade happens only when the buyer and the seller agree on a price for the security, but the price which they decide on should not be higher than the bid or lower than the ask. So typically, if a trader wants to buy a security immediately, he buys at the ask price, and if he wants to sell the security, he does it at the bid price. For example, if a current price quotation for the security X is rupees 100.50 divided by 100.55, in this the 100.50 is the bid price and 100.55 is the ask price. So the investor A, who wants to buy the security at the current market price, would pay 100.55 and buy, and investor B, who wants to sell the security X at the current market price, will sell and receive at rupees 100.50. Coming to the bid and ask spread, the difference between the bid and ask prices is called the spread. Spread is the key indicator of the liquidity of the asset. As mentioned, the ask price is the lowest price the seller is ready to sell, and the bid price is the highest price the buyer is ready to pay for the security or the share of the stock at the particular given point of time.
What is market volume? Market volume refers to the total amount of transactions that were bought and sold, that is, traded over a specific period. The period may be a day, week, month, quarter, or year. The word volume has several possible meanings, including the level of sound, the amount of space, and the amount in general. In this context, the word means the amount in general. We use volume when talking about the size of a market.
What is day trading? Day trading refers to buying and selling a security within a same or single trading day. It involves making short-term trades, never lasting more than one day in an attempt to make profits in the financial markets. Day trader is the operator who indulges in the day trading. Some day traders are very active, making many trades every day, whereas others may enter and exit only one position per day. A successful day trader must know which stock to trade in, when to enter a trade, and when to exit it. The most common day trading markets are stocks, foreign exchange or forex, and futures.
In the market, if you own shares of a company and expect it to rise, it is considered a long position. But if you are bearish about their future and sell them even before they are transferred in your name, it is called a short position. Typically, when an investor shorts a stock, he borrows the share in a margin account from a brokerage firm and sells them. Having said that, long and short positions are mostly related to the derivatives of futures and options segment, where the trading happens in the present for future delivery of shares. So, your trade in the F&O segment is accordingly termed as long or short. When you as a trader buy a future contract of any index or stock in anticipation of a price rise in the future, you are said to have built a long position. On the other hand, when you as a trader sell a future contract of any index or stock in anticipation of a price drop in the future, you are said to have built a short position. In future and options, you choose calls or sell when you are bullish about a stock or index and expect the price to rise in future. So, in a long position, investors choose the call option, and those opting for a short position select the put option. A put option in the future and options segment is opted when the investor is not bearish about any stock.
What is market capitalization? Market capitalization, also called as market cap, which is the total market value of the company's outstanding shares of stock. It is calculated by multiplying the total number of outstanding shares by the current share price. It gives us the total worth of the company on the open market, as well as market's perception of its future prospects, as it reflects what the investors are willing to pay for its stock. Types of market caps. Large cap. Large cap companies are the firms with a market value of $10 billion or more than rupees 20,000 crores. Mid cap companies are businesses with a market value between $2 billion and $10 billion, or above 5,000 crores and less than 20,000 crores.
What are blue chip stocks? Blue chip stocks are the shares of blue chip companies. Blue chip companies are companies that investors and consumers see as solid, established, reliable, and profitable. That is, one of the leaders in their industry. Blue chip stocks belong to companies that are well established, financially stable, and have been in business for a long time, demonstrating resilience in the marketplace. Blue chip stocks have shown resilience in reputable market indexes such as the Dow Jones Industrial Average, FTSE, Nasdaq, and Nikkei. If you want to invest long-term in something secure that also pays dividends, you should seriously consider blue chip stocks. Businesses that haven't yet proved themselves in the marketplace shouldn't be considered if you are risk averse. Somebody who is risk averse does not like risky investments.
Price to earnings ratio, or PE, is a way to value a company by comparing the price of its stock to its earnings. The PE equals the price of a share of stock divided by the company's earnings per share. It tells you how much you're paying for each dollar of earnings. Low or high PE ratios aren't inherently good or bad. When a PE ratio is low, it could mean that investors are losing confidence, selling shares and driving the price down, while earnings hold steady. The PE could also be low if the company's earnings grow quickly, before investors notice and start buying shares, driving the price up. Similarly, a high PE could result if investor excitement drives the share price up, while earnings remain low. Or that high PE may be justified if the company is poised for growth. Make sure you research companies carefully. Compare the company's PE to others in its industry, and analyze any inconsistencies.
Diversification is a risk management strategy in which you spread your investment dollars among different securities, sectors, and industries. The goal of diversification is to protect the value of your overall portfolio in case a single investment, sector, or industry takes a downturn and moves against you. A sector is a broad group of stocks, often in one industry, for example, the healthcare, technology, and retail sectors. An industry is a more specific group of companies producing similar products or services. For example, in the technology sector, there is the social networking, internet, software, and hardware industries. An index reports changes in a specific sector or in the economy. Indexes are important to measure how your company is performing in comparison to other companies in the same sector or the economy.